do we do at TheoTrade? We have very definitive opening and closing criteria, and that's what the classes, our mainstay and our classes are really about. It's about getting into, again, very specific criteria for each unique trade. And that's where we spend a tremendous amount of our time on a day-to-day basis, is focusing specifically on criteria. And what criteria does, it says which options to trade, what expiration, what do I want the stock to be doing, what should the implied volatility be doing. It puts the pieces of the puzzle together. Here, you got to look at this. Again, you got to kind of learn to put the blocks together before you start building, this magnificent block castle, if you will. So now let's move forward a little bit to selling spreads, because we talked a little bit about buying spreads. We talked about the equivalent of selling spreads. But here, again, we're going to reiterate a little bit about selling spreads, because we're going to start to talk about probability. And the next, 15, 20 minutes is essential in your longer duration, like learning curve. This is, again, the absolute essentials are coming up here. Selling spreads. When selling a spread to open, you receive your maximum profit up front. And we've already done a little bit about selling spreads. If you sell to open a $10 spread at $3, your maximum loss could be $7. Therefore, in a margin account, your reduction in buying power would be $7. Now, that's where I talk about reduction in buying power over there. Now, to look at this again, so I'll kind of reiterate. This is going out, all right, into a product like Google. Whoops. We go into Google, and let's say Google, for example, is trading, and I'm just going to throw a price out there. We'll say Google is trading, at like 700, and it could be stock is trading at 700. The idea of selling a spread, okay, what is it? Whether you're bullish, whether you're bearish, in this case, we'll do bullish, you can go out there and sell, all right, 680 put. You can sell a 680 put. And this is a really big product. Now, if you sell a 680 put, the stock's trading at 700. Selling a put, you're selling somebody the right to what? Sell you stock at 680. You don't want that stock to go down. You want that stock to go up. But then you turn around and you buy, for example, a 670 put. That's a 7, I promise. Okay? And buying the 670 put. Why are you buying a 670 put? Just in case. Come on, this is a $700 stock. Couldn't this $700 stock go boop all the way down here to 500? It could. So you're selling the 680 put because you want to collect the premium. Why are you buying the 670 put? Because you're not totally insane, right? The entire trade is done for a $3 credit. So the trade is done for a $3 credit. But how much risk do you have? Well, it's a $10 wide spread. So what can you lose in a $10 wide spread? You can lose $10, of which you collected $3 up front. So your maximum risk is $7. We're going to go through this a number of times over here, just kind of reiterating, a few of the examples. Bullish spreads when the stock is at 48. Buying a vertical call spread equals selling the vertical put spread. And again, just looking at the equivalence. So you can actually get bullish by doing what? Buying a call spread, or again, selling the vertical put spread. Bearish spreads when the stock is 48. And I'm just going through some of the similar examples here. Bearish spread, stock is 48. You can buy the put spread, or you can sell the vertical call spread. Again, to do the opposite, you kind of do the same. And this is just mind-like blowing the first couple of times you see it, because it's confusing. You're like buying a vertical put spread. Sometimes listing it like this makes it a little bit confusing, but this is one thing, again, I like to drive this home over here. If you have a stock's at $48, and you happen to be bearish on there, okay? You're turning around, all right, and you are buying a 45 put. Now, if you buy a 45 put, again, happens to be a bearish position, you want the stock to drop. But then you're turning around and you're selling a 40 put against it. So why are you doing that? Because buying a 40 put, it might be expensive. Like, I just want to make that clear. Like, this put this thing could be trading, if this is a high volatility stock, this thing could be trading for like $3.50. This could be, again, a high volatility stock out there. Then you sell the 40 put. Why do you sell the 40 put against it? Because it might, offload a little bit of the risk over here. You might be able to sell this put, maybe collect like $1.50 on it. So instead of paying $3.50 for just the put, you do the actual spread. And what does the spread get you? All right, gets you in there for what? A lot less. So all of a sudden you take, you have $3.50 at risk, you chop off $1.50 of it. You're feeling a little bit better about where you stand. All right, it's about $2 debit. It's about a $2 debit, and it's a $5 wide spread. The most you can make on a $5 wide spread is $5. You pay $2 up front, so the most you can actually make is $3, right? So you're risking basically $2 to be able to make $3. It's all well and good. And then you look at this, and this is the exact opposing spread. It's just the same animal. See these 40 calls, okay? These 40 calls, they're already what we term in the money. Now the stock at 48, 40 call. If I looked at a 40 call with the stock trading at 48, the minimum the 40 call is going to be worth is $8. And this would be one, again, we'd be selling the 40 call for $8. Then you turn around and buy, okay, the 45 call. Now, what would you be buying the 45 call for? In this particular case, again, whatever you do over here is going to reiterate over here, meaning this is a $5 wide spread. This is a $5 wide spread. Here's a spread that you bought for $2. You can make $3. Over here, you could actually collect your $3 up front. So this thing would be trading for about $5. Okay. And net, what do you get over here? And this one becomes about a $3 credit. Can't even fit it in over there. It's about a $3 credit. And a $5 wide spread, if you collect $3, what, up front? What can you lose? $2. So the spreads become interchangeable. And that's all I really want to keep reiterating, all right? And you would never do necessarily both spreads. You do one or the other. And which one you do, though, that's the critical portion of the criteria. In fact, we cover that in extent in the in-out spreads class. The in-out spreads clearly defines, right, that many of the times you're on the buy side of the spread, not the sell side of the spread. The reason I spend so much time on this is because I don't want you to think that you have to buy a spread or you have to sell a spread, because it's not true. Selling spreads is not necessarily better than buying a spread. Now, here is, again, one of the essential building blocks of all trading. Short spread probability calculation example. All right? So we're going to go through this a couple of different times over here, and this is an example in Google. What I want you to get into the notion of doing is when you look at a spread, okay, and here's a spread, and I took a snapshot of it. This is a $10 wide spread. It happens to be a bearish spread. We're selling a spread. And again, this is called a short spread. It's a short spread. You are selling the spread to open. This spread is done for credit. So I want to reiterate, it's a short spread. It's being done for credit. The credit happens to be $3.80. Now, identify the width of the spread. Identify the credit. Because what you're going to need to know is out of the width of the spread of the credit. If you sell a $10 wide spread for a $3.80 credit, what can you lose? Well, $3.80 you collected up front, it's $10 wide spread. The real risk in here is $6.20. Again, that's what we call the total you can lose, the width of the spread. Why is this critical? Real risk, again, is the width of the spread minus the credit received. You can put together a probability calculation. Now, people constantly, they spend time looking at probabilities and different risk graphs and so forth. Have you seen me use a risk graph more than once? And all of this options 201. If you want to get proficient at trading options, you will use this calculation. You won't use any risk graphs. You won't use any piece of software. What you're going to learn is that price, this is price, is also probability, that they're actually one and the same. So what you do, if you ever want to figure out the probability of a short vertical spread, that's when you sold, take the real risk, which is how much you can lose, and divide it by the width of the spread. So $6.20 divided by $10 equals, this trade should have right around a 62% chance of making 1 penny or more. 62% chance of making 1 penny or more. Now, time out. Let's go into the live market and let's identify the exact same thing. This is something that I've been asked for, the better part of a decade and a half. Like, how the heck can price be the same as probability? It's always been that way in markets. So we're going to open up an option chain. We're going to open up a few more strikes here. We'll open up like 20 strikes. And all we're going to do is we're going to bring up a trade. We're just going to bring up a trade here, and we're going to look at price and probability. So I'm going to sell the 630s. I'm going to buy, the 635s. Now this is a spread. It's a $5 wide spread. Okay, let's just round the numbers off over here. I'm going to lock down price. I'm going to round the numbers off to, let's say, 220. I'm even going to open up this left side bar, and then I'm going to go to my trusted calculator so everybody sees, me actually go through kind of the equation. Now, the first thing you need to identify is what? What is the width of the spread? It's a $5 wide spread, right? $5 wide spread, of which you collected $2.20 up front. So one thing, if people, they get a little confused, just check the max profit and the max loss. The max loss is $2.80. So it's $2.80. It's the other side of $5. So what do you have to do to figure out probability in this trade? Take the $2, and what? Take the $2.80, divide it by the width of the spread, equals $5. What do you come out to? About a 56% probability in this trade. Okay, now we're going to change the strikes a little bit. Let's do one that's further out of the money. So when I say further out of the money, I mean that was a trade that we did the 630, 635. Let's go all the way out here to these 660s. We're going to sell the 660s, and we're going to buy the 665s. Again, we're keeping it to a $5 wide spread. Now it's being done for about $1.35 credit. Okay, so everybody is completely clear. It's a $5 wide spread for $1.35 credit. So just take you through it. $5 wide spread minus the $1.35, that you collected up front. It leaves you $3.65 of risk. Take the $3.65 of risk. Again, it's the real risk divided by the width of the spread. It's $3.65 again divided by $5 equals, a 73% probability of making 1 penny or more. Now, we can go through hundreds of these, and the question always comes up, like, how can this possibly work? It's one of the most essential things in spreads. Don't look any further than price for probability, right? Trades will tell you what the probabilities happen to be. And for those of you that, you've gone through a little bit in Options 101, now on the Options 201, people rely on these probability calculations. And the probability calculations, let me tell you, they can be effective. Like, look, here's a 660, 665 spread. And lots of trading applications will have probability calculations on them. But the most effective thing that you can do is to run through the calculation that we just showed you and not rely upon the technology. It's because the technology, you could be missing something. Price and probability are one and the same. All right, we're going to do one more, but this time we're going to do it with puts. We're going to go out there, with puts, and we'll switch the underlying. We don't need to use Amazon, We use, for instance, we could use Google, and I'm intentionally picking really high value, stocks. And the reason I'm doing that is because like a $735 underlying seems like so out of reach. You're like, it's so scary. But in this case, let's just go out and let's sell the 710s and buy the 700s. And this right here, this is a $10 wide put spread. And again, we'll just toggle the price just a little bit here, just to show you, like, here's a $2 wide credit, $2 credit on a $10 wide spread, just to make the math a little easier. Again, it's a $10 wide spread, which I identify, and $2 credit. And to kind of scope this out for you a bit more, We're not even going to need a calculator over here. Always identify the width of the spread, which is $10. Then the credit received. So how much risk is in here? $8 equals what we'll call real risk. Take the real risk divided by the width of the spread, which is $10. Probability in here, 80%. Now, if you look at this probability calculation on, live trading application, probability calculation, it's pretty much spot on. Note, I adjusted the price a little bit, otherwise it would be absolutely spot on. Use your probability calculation. Don't use this column, because you're not aware this column could be based on different implied volatilities. Make it easier. Risk, real risk divided by width of the spread. Essential tool for building, upon your education in options here. And again, this calculation, it's in the PowerPoint, it's in the notes, you have it. We'll go through it a couple of times. Here's a short call spread, stocks trading at 200. You sell 210, 215 for a buck. Come on, what's the probability in there? If you collect $1 up front, this is a $5 wide spread. So what's the calculation? Well, it's a $5 wide spread. If you collect $1 credit up front, definitive out-of-pocket risk is $4. Take $4 divided by the $5 wide spread, should be about 80%. There you go, 80%. Do it again. Break-even points, everything. Here's a short put spread, stocks trading at 200. You sell what? The 190 puts, buy the 185 puts for $1. It's a $5 wide spread. You collect $1 up front. What's definitive out-of-pocket risk? $4. Take $4 divided by a $5 wide spread. What does it come out to? Probability, 80%. Again, just hammer it, hammer it, hammer it. Just keep doing these things. And if you went further out of the money, it'd be what? Higher probability. But higher probability takes more risk. This is just the entrance. There's so much you can do. Once you start understanding probabilities, it will blow your mind. Long spread probability calculation. What's a long spread? Spread that you're buying. Spread you're buying. And I actually take you through the opposite. Here's the total risk. And again, this is a Google spread. Again, we're buying the Google spread. All right? So there's debit spreads and there's credit spreads. And this debit spread, you needed to know the probability. So the total, in there, the width of the spread is $10. The real risk is the debit on the trade, which is $4. That's the total you can lose. The real risk is, again, the debit of the spread. The probability, the real risk divided by the width of the spread. It's the same. Just take the $4 debit divided by $10. This trade has a 40% probability. Now, make it even easier. We're going to go back into the live market over here. And, this is one of the most important areas, again, the most important areas of trading. And so few people get it. Like they don't get it because they've never been taught this stuff. So remember that spread we were doing a moment ago? Here it is in Google. This is a spread that if you sold this spread, and we were talking about selling it for about $2, right? If you sell a $10 wide spread for $2, it has an 80% probability of making 1 penny or more. But what happens if you don't sell the spread? What happens if you buy the spread? It's the same $2. It's just the opposite. Instead of having an 80% probability, now you have what? $2 is the real risk divided by the width of the spread. This is a 20% probability of making 1 penny or more. That's not very good, and it's not. And you can go into any product that you want. You can look at this. Let's go to something like that doesn't even move at all. Microsoft. Come on, Microsoft's like a stock with a nail in its foot. What has it done? What has it done for me lately? 50, 51, 55, whoops, 51, 52, 50. Doesn't do very much. Go look at some spreads, though, inside of Microsoft. We'll even go 50 days out. 50 days. We don't need this many strikes because Microsoft's not exactly a mover or a shaker over here. But look how little there is to even sell in this marketplace. So you can go out there and you can convert like buying spreads or selling spreads. But here in this case, let's sell a 50, for instance, 48 spread. Here's a $2 wide spread for a 55-cent credit. All right, for a 55-cent credit. Now, go through the math. $2 wide spread for 55-cent credit. How much out-of-pocket risk do you have? Right? If you want, you can hit confirm and send over here, and it's going to show you it's $1.45. So to figure this out, again, how do you figure it out? You take the real risk in the spread. Now I'm selling a spread. Take the real risk in the spread, which is $1.45, okay? And you divide it by the width of the spread, which is $2, equals this spread has about a 72% probability of making 1 penny or more. What happens if you didn't sell this spread, though? Let's turn around and buy the spread. If you buy the spread, all you have to do in the calculation is you're like, wait. Now he's buying the spread. And again, this is the stuff that you go back and forth. You take the real risk in the trade divided by the width. And what's the real risk in there? And I go back to the trading application. All right. The risk in the spread is 55 cents. So take 55 cents, divide it by $2. What do you come out to? 27%. Just the other side of the trade. So what do you want? Do you want the higher probability or the lower probability? Everything in trading has trade-offs. If we can get you to this point in spreads where you understand the probabilities involving in spreads, you're going to evolve very, very quickly, okay, in the markets. You will evolve very, very quickly because you're going to start to see spreads for what they are. Everything is probability and chance, right? We learn to rely more on probability and less on what you think occurs in the market. Because what you find in the end, probabilities are always going to win. So I'm going to leave these calculations to you, and they're going to be in a PDF file, of course, attached to all of these archives over here. There's the last few points I'll make with spreads. Size matters. And I felt this is more criteria, but all right, select a contract size for an iron or spread whereby you're 100% comfortable taking 100% loss. And really, I just wanted to throw this up here because, and this should say actually spread, but there's no superheroes in trading over there. Okay, you got to trade small. You got to live to be able to trade another day. And, this is an old saying that's been used, but, there are old traders and there are bold traders, but there's no old, bold traders. Of course, an old trader said that. The only reason I throw this in here is you recognize that trading is about probabilities. Then you recognize that trading small has to be essential because for probabilities to be able to play out, you have to have enough occurrences. So you have to select a very, very small contract size. And it's just, and I want to get you thinking that way as we start to bridge our way to more complex strategies, that every individual trade doesn't really make any difference. Like when I say the individual trades, each individual trade is just a smaller piece of a much larger puzzle. Trade really, really small, okay? Because you're taking probability shots. Higher probability is only better if you know how to mitigate risk. Now, the ins and outs, okay, of spreads. So we've completed some of the key components of building and understanding probability in vertical spreads. Again, the skills along with TheoTrade criteria, it's going to be instrumental over the duration to build your knowledge, okay, and really working and trading knowledge of options. But vertical spreads and probabilities, this is the foundations of options trading. Every strategy from butterflies to iron condors to broken wing butterflies to vertical rolls to iron butterflies to back ratios, they're nothing more than combinations of these vertical spreads and probability. So as we move forward, again, those are some of the building blocks. In some future courses here at TheoTrade, you will see me start to take these, all right, and use them in iron condors. You'll see me to take the probability and use it, of course, in butterfly spreads, or for instance, in in-out spreads. All of them, okay, all of them are essential building blocks, and this is the background behind that. Now, in the next section, we're going to start Options 201 Calendar Spread Essentials. Calendar spreads is going to be the other primary building block. And what I'm trying to get you to, and I'm kind of leaving you hanging here a little bit with the vertical spreads, we didn't get into any context per se in the last two parts of this session here about how to actually trade these. Exactly. We just had to get, all right, those blocks behind us, understand what's essential, okay, and what's more trivial. Now that you understand probability price, okay, now that when you understand to do the equivalent, you do the same, which basically means with a call spread that you're selling, you can buy a put spread. Now that you've got those behind you, Okay, now and only now can we go back and really start to hammer home criteria. And again, what criteria amounts to is selecting the right expiration, selecting the right probability, which can be based on delta, selecting the right contract size. All of those are facets of finding effective trades. Even, the right value of a spread. There is a probability that's more effective than another probability, but we had to get those building blocks behind us. Again, when we move forward into part 3 over here, we're going to be talking about calendar spread essentials. So stay tuned for part 3 starting tomorrow. Thanks a lot, everybody, for joining us here at TheoTrade and for the Options 201 Vertical and Calendar Spread Essentials.